Legal disclaimer. Bespoke Group investment advisory services are offered only through Bespoke Advisory, an SEC-registered investment advisor. Everything we share here is just for information and education. It's not investment, legal, or tax advice. Bespoke does not offer or solicit investment services to the general public. And as always, investing comes with risk, including the possible loss of principal. Today I'm speaking to Matt McClintock, Bespoke's co-founder. And today we are going to clarify exactly Bespoke's relationship to Bitcoin. Matt, when I have been out in the world and people ask what we do, and I say, we're a multifamily office, like I've kind of, figured out how to try to explain what we do without pigeonholing us. And it's like, yeah, but we're different really because we built around Bitcoin. And then there are all of these assumptions that are made. And they're like, oh, okay, so you're a crypto investing firm. And I'm like, no. And, and it's like, oh, a crypto it's so volatile. And like, God, like, how can you even like build around that? And I'm like, well, it's we're not really, so maybe what we should do is like explain what we're not and what we're not doing. But also I think a great way to start is just to like Bitcoin came to us. Bitcoin came to you and then we built around it. So let's get really specific about our relationship to Bitcoin.
Yeah, that's great. I love that. Yeah, you're right. Bitcoin came to me slash us in 2017. I wasn't looking for it. I was minding my own business, having a great law practice with a friend of mine, Jonathan, and we had an opportunity to work with a very affluent family who just happened to have a whole lot of wealth in Bitcoin. And at the time, it was like a record scratch moment for me. I said, I'm not sure I'm not sure. Again, this is now 8 years. Is that right? Yeah, 8 years
Wow.
ago. I'm not sure that I had heard the term Bitcoin. Certainly hadn't thought about it enough to form an opinion one way or the other. I was minding my own business, practicing law, doing law stuff. But we met with this family, and I was intrigued by the prospect of a family who had a tremendous amount of wealth in an asset I didn't understand. Um, and that sent me on a bit of a learning journey. And it didn't sit right with me that a family whose entire legacy, financial legacy, was tied up around this asset that I just didn't understand, and that apparently nobody else that they talked to would even take seriously. It just didn't sit well with me that they had no options. And after meeting with this couple, this is one of the rare occasions when I would actually drive to go see a potential client. I did this as a favor for a friend who had referred the client to me. And Jonathan had come with me, my co-founder that I mentioned. And on the way back from that meeting, we were talking in the car about whether or not we know enough to help this family. And Jonathan was taking the side that, you know, we don't know about this asset. It's like, how can we help these folks? And I said, I think we have to figure out how to help these folks because, as I mentioned, I mean, this is the totality of their wealth. And just because we don't understand it doesn't mean they don't have options. The unlock for me was there's like an epiphany. It's like, wait a second, if we can figure out how to transfer the legal ownership of this unusual asset to a fiduciary structure, and have that asset owned by trusts or other structures, then if we can figure that part out, then everything we've ever done for anybody else, those options are available. We just have to do some homework and figure out what this is.
Get
And so
creative.
get creative, think differently, and just be willing to embark on that journey, not knowing where it would lead. And along the way, I just became really interested in Bitcoin. I That started me out trying to learn everything I could learn. I read Satoshi Nakamoto's white paper. I still read it a couple of times every year. Um, but I I had to read it half a dozen times before I even started to understand what it was about. And so that's what started us for. And along the way, those clients, once we had done the implementation work around their structures, the inevitable question came, can we pay you in Bitcoin? And I knew the answer had to be yes. I mean, no, no could not be the answer. Um, and so I said, okay, yeah,
Sure.
teach me how to do that. And so the clients taught me how to do that. We set that up, and they paid us in Bitcoin. And that was I met the clients in the fourth quarter of 2017, and we completed that first round of work in 2018. It was February of 2018 that we finished that work. And along the way, we got to know this family quite well. And I think they really latched onto us because it seemed like finally they had some professional advisors, in this case lawyers, who took them seriously.
That's what I was gonna say. They were
Yeah, yeah,
they were
yeah,
being taken seriously probably from the first time because, I
yeah.
mean, at that time and still there is, like, such a not it's getting better, right? Like,
There's a
it's
stigma.
changing.
There was
It's, like,
definitely a
taboo
stigma.
yeah, yeah, and
Yeah,
so
definitely a
but
stigma around it. Yeah.
yeah.
There's a huge stigma around it to the point where I was very coy at the time talking about that we're helping this family with Bitcoin. It's like you might as well tell people that you're helping them sell children or you're funding terrorism or things like
Yeah,
that.
the
It's like because it was
associations were crazy.
yeah,
Yeah.
yeah, definitely, definitely. But we background checked these people. We ran OFAC searches on them. We checked everything we could check to make sure that we were not doing it, that these people weren't criminals. And by the nature of the structures that we were creating, they would have to go through a KYC or know your customer type of engagement with any fiduciary who is going to serve as the trustee of these trusts. And so we had to know these clients were clean, above board, all that kind of stuff. And so they were. It just we happened to be helping these people with an asset that very few people understood. And along the way, as we built trust with this family, they just said they wanted more and more relationship with us. They said, well, this has been really great, and now we've got all these structures put in place. Can you help us make sure they keep running properly? One of the things that they wanted us to do was manage real estate acquisitions and sales on their behalf in a way that was highly private. And so we said, sure, we can do that. We'll figure out how to do that. But we're not going to do that in the context of a law practice. Law practices are subject to regulatory oversight by various bar associations, and I was and still am admitted to practice law in 4 jurisdictions. Jonathan's also licensed in California. And so we had a lot of regulatory oversight we that we knew that we'd have to be navigating when we're dealing with non-legal services. We're dealing with family office type services for these people.
So that's great though, because then you're positioned to like actually like you can work with the lawyer or the estate planner now you
Yeah,
work with
yeah.
them.
I mean, that set the course for where we ultimately are now, because along the way we had started becoming a family office for this family without. I mean, I not even just like I was so naive about Bitcoin, I was naive about family offices. And so we would just they say, "Will you do this?" We would say yes. "Will you do this?" We would say yes. And so we said, okay, well, we're going to build a company around this because it's a completely different service model than the law practice. Well, I don't know how to price that for a law practice. It's not like you're asking for legal work, you're asking for administrative oversight, strategic work. We're not going to run that through law practice. And so um, the idea for Bespoke was born, and the nature of calling it bespoke is that we were creating something fresh for somebody that it was built around their needs. It was tailored to fit for them.
Can you clarify how we look at Bitcoin as an asset and the growth potential around Bitcoin. I was going to ask you, what do when we're talking about 2017 and then we're talking about now, and so much has changed in just the world. The world has changed, circumstances have changed. So there are different circumstances now that you're looking at as Bespoke develops and than when you first started. And we've seen these examples of and I'm going to need you to probably slot in because I'm going to be using like layperson language to try to describe like this kind of technical thing. But people and finance people and industry has like really built or tried to build around Bitcoin or crypto to grow, and then it kind of it bursts. Like it
Yeah,
doesn't.
it works when the price is going up, right? And then
And then it doesn't work.
right. Yeah, with
And
the
so
volatility cuts you the wrong way, and then you wash out.
and that's
Yeah.
why people are right when they're like, well, Bitcoin's really volatile. Like, how do you build around that? And they're right, because look at those examples like FTX and et cetera.
Hmm.
But I want you to clarify like how we look at the alpha or the growth around Bitcoin, because it's really different, and I think it's important to highlight.
Okay. Yeah, along the way, starting in 2018, because Bitcoin was my first intro into blockchain technology and digital assets that can serve as a economic value of some sort. It's like a recording from a podcast is ultimately a digital asset, but who the hell's going to buy that? You know, songs that we access through Spotify or Pandora, or that we go and buy the old-fashioned way from iTunes. Um, those are digital assets that are unique digital assets. Photographs that you have on your computer, those are digital assets. But these blockchains, Bitcoin was the first and is the longest running successful blockchain. um, Blockchain technology created this opportunity to have what are called fungible digital assets that can be used for value exchange. And fungible meaning that one Bitcoin is the same as any other Bitcoin. It's like a dollar bill in your wallet is the same as a dollar bill in somebody else's wallet. It's the same. The dollar is a dollar. A Bitcoin is a Bitcoin. And so that's what I mean by fungible. There's nothing specifically unique about the dollar bill in your wallet or the dollar bill in my wallet. Yes, you may draw a cute picture on your dollar bill, and I may draw a different picture. And so they're different in that respect. But as far as negotiability and the value of that dollar bill, it's the same in your wallet or mine. Same thing is true with Bitcoin. Same thing is true with the vast majority of other digital assets. And so Bitcoin created this opportunity for us for the first time to have this fungible, transmissible um, form of value that exists only electronically. And I thought that was fascinating. And so that sent me around a hot lap that lasted about 5 years of the whole broader crypto space. Well, if Bitcoin is this, what about Solana? What about Ethereum? What about you name it? And so I spent about 5 years or so, like I said, kind of exploring the warren of different digital assets, and realizing at the end of it all, at the end of that journey, where I kind of landed the last couple of years, is that Bitcoin is truly unique. The Bitcoin is unique in that it was not launched by a company seeking to raise money. It was launched as a peer-to-peer project designed to create a medium of exchange, a peer-to-peer electronic cash system that was free from interference by any intermediary third party. That is fundamentally unique to Bitcoin. Ethereum, which is the second largest digital asset by market capitalization, by token value, started as a project to raise funds to fund distributing computational power. There's not really a company behind Ethereum, but there is an Ethereum foundation that pre-mined, that created all of the tokens out of thin air and then started distributing those tokens. And the vast majority of every other digital asset has a very similar origin story, or they were um, they were created at the inception of a company and then sold on the marketplace or just dropped on the market to create a network effect to then cause the value of the token to rise in what's effectively tokenized form of venture capital. And Bitcoin is not that. And so because Bitcoin has these unique qualities, that is why it has endured. And that is why I believe it will endure, is because it is fundamentally different than any other digital asset. And it took me, like I said, a 5 year tour of duty, if you will, in the broader crypto ecosystem. And unfortunately, that's a long journey. It's a technical explanation. And for people who are new to this type of asset, they think that Bitcoin is crypto and they think it's all the same. It's like, no, you have to do the work to understand why it is fundamentally different.
So I want to zero in on this for our listeners. This is really about the difference. I mean, Matt just introduced it, he got into it, but this is the difference between Bitcoin and other cryptocurrencies, and why they should be assessed and thought about differently. And like when we say, or when the reason that we say Bitcoin usually and not
We
crypto
mean
is because
Bitcoin,
we
right?
mean Bitcoin. And
Right.
I want to like really break that down and get specific, because I mean, even for Matt, like, we've spoken to lawyers, like we know that there is just kind of like just some education that I know people are yearning for about like what the difference of those things are. And you broke down some of them. The thing I want to ask you about is like, so why is the feature of there not being like a third party or a company behind Bitcoin, which is unique to every other cryptocurrency? Am I getting that right?
Yep.
Why is that so important?
I think that's a critical feature because you don't have to trust in the issuer of the Bitcoin for the integrity of the asset to endure. The asset is the asset. It's like gold. It's like who makes gold? Well, God made gold, or the Big Bang made gold,
Mother
or
Nature,
whatever. It's like Mother Nature,
Mother
Mother
Earth.
Nature, Mother Earth, Gaia made gold. It's like Satoshi Nakamoto is not Gaia necessarily. I'm not making that equivalency. However, the whole reason that Bitcoin exists is based in purity, not based in capitalism. Nakamoto did not release Bitcoin thinking that it was, I mean, I don't know what he thought, but he didn't release it to say, hey, I want to fund this new startup company. We're building the most incredible blockchain that's going to do all these promising things, whatever. It's like, no, if you read the original white paper, Satoshi announced the creation of Bitcoin as a peer-to-peer electronic cash system. The specifically, this is very clear in the white paper. This is clear in the Genesis block in January of 2009. The reason Nakamoto became focused on Bitcoin is because there was so much tomfoolery around the great financial crisis and the great money printing that was going on, the bailouts of the various banks that were deemed to be too big to fail by various regulators and governing authorities. I mean, this is in the Genesis block of the
Too big to
blockchain.
fail. What a
Right.
line.
Yeah. And so it's like, well, if they're too big to fail, who gets to be the ones that bail them out? It's the taxpayers and or it's the customers of those banks who don't otherwise have the ability to exchange value for each other. And so Nakamoto very explicitly sought to create a money system that was independent of these too big to fail banks because they invariably fail. And so the idea of no central issuer and no central controller, no central intermediary that manages the issuance of Bitcoin, it's a peer-to-peer electronic system. And the that has proven to be irresistible.
It kind of like breaks your brain a little bit. Like
Yeah, it's a tough challenge.
it kind of broke my brain. I mean, Matt, we've recorded a version of like we've been recording and talking about Bitcoin. for months, like in my podcast host training, and I remember like that piece. I remember in like one of our first conversations, I'm like, well, why is that important? Like, why is the middleman not being there important? So yeah,
Because you have
it
to
kind
trust. Because the reason not having the middleman is important is because, first of all, that middleman is getting paid every single time something crosses his desk, and secondly, because middlemen fail, and middlemen have ulterior motives. Um, and Nakamoto thought this isn't right. And I think it's important. I mean, I think Nakamoto's, um, I think the mystery of who he or she or they is or was, I think that's important to the narrative because you don't have somebody out there. You look at every other crypto project out there, you got to know. There's Vitalik Buterin. Everybody knows who he is. He's the brainchild. He and Joe Rubin are the brainchildren behind Ethereum. You can do the same thing with Solana. You can do the same thing with every other blockchain protocol. These are fallible human beings that have financial motives that are crystal clear. Nakamoto is still unknown. Nakamoto may very well be dead. Um, the the tokens have not moved. He has not cashed out. That's part of the beauty of the blockchain. We know where his tokens are. He hasn't cashed out. So those millions of Bitcoins that Nakamoto mined early on, before the network really even became what it is now, those will probably never move. And so why is that? The It's because I believe Nakamoto had a bigger vision than enriching himself. His vision was to create a better money, and he did that. And that's what Bitcoin is. Bitcoin is better money, it is pristine money. I think it's important too, and Nakamoto was very clear about this too, both in the white paper and in the hundreds of posts that he posted on the Bitcoin Talk forum in the years leading up to and in the few years after the launch of Bitcoin. And he famously walked away from the Bitcoin project, I think it was 2010 or 2011. So, um, within a couple of years of it launching, he said, I'm moving on to different things. Um, it's important to realize that Nakamoto was not claiming that he invented much of anything. Nakamoto was able to weave together different solutions from different cryptographers dating back decades, and he combined those into something new that solved some impenetrable, vexing problems that made prior versions of a peer-to-peer electronic cash system. He put them together in ways that would solve for peer-to-peer electronic cash in ways that people hadn't done that before. And I'm not discrediting him at all. He had the genius to weave these things together, but so much of what Nakamoto did was a synthesis of work by David Chaum, Adam Back, Hal Finney, Nick Szabo, and other people who were there at the beginning of Bitcoin. And so in that sense, Satoshi Nakamoto is all of those people who worked on the Bitcoin project to get it to where the code base is, and the core developers who still today, every day, focus their energy on building and perfecting and refining Bitcoin. Bitcoin it's not the static thing, it's a living code base. And so the core developers that are still working on Bitcoin, they are also, in a very real sense, they are also Satoshi Nakamoto because they are building and refining and expanding on the network. And I would go so far as to say those of us who run a full node that's keeping a copy of the Bitcoin ledger, every transaction that goes across that, we are Satoshi Nakamoto. I think those of us who use Bitcoin as a medium of exchange, those of us who use Bitcoin as a store of value, we are again kind of living in the reality of who Satoshi Nakamoto is or was. And so I know that sounds kind of metaphysical or philosophical, but I think that there's a truth to that.
No, it felt very I did. I was like, wow, I'm going to sound pretty new agey here when I say that there's a bit of a spiritual feel to that, right? Because it's kind of like this source, and then there's like the stewards of that.
Well, and I don't want to denigrate I don't want to denigrate new aginess, but I also don't want to diminish the gravity or the seriousness of an asset that Bitcoin is,
Yeah,
because if we go down a new age bent, people stop taking the conversation seriously and
I
think that
know.
we're just gonna go drink some mushroom tea or
Yeah,
whatever.
yeah,
But the reality is that as this thing continues to live forward, um, it has its own gravitational field. Michael
yeah.
Saylor, what he's doing with strategy, Larry Fink, what he's doing with BlackRock, the core developers, the companies like Bespoke that are building around and on Bitcoin, the clients that we serve who built family legacies on Bitcoin. This is the first generation of Bitcoin owners.
You were saying that like Bitcoin was created because we needed a new money. Um, can you tell me I wanted you to unpack that a little bit. Like what are the flaws of our current money?
Well, I got to tell you, I'm not a monetary policy expert by any
Okay.
means, but um, the at the if we strip it back to its core, what is the role that money plays in a society? It's to create something with which we can exchange value for goods and services with each other. Well, what would happen if we didn't have money? Well, we'd end up inventing it at some point, but back in the days before we had a monetary good, we would barter with each
Barter.
other.
Yeah.
Yeah, we'd say, I will perform various services for you, or I'm a farmer and I will grow crops and I will trade you a bushel of cotton for, you know, a pig or some apples
Yeah.
or for you to paint my barn or whatever it was. And so it's like, but what you run into is this idea of non-parity of desires. Especially so again, if
Non-parity?
we're by which I mean, let's say that we're not let's say the internet doesn't exist, but we're sitting around our little farming community. And I'm growing all the cotton I can grow, and you're growing all the apples that you can grow. It's like I'm kind of appled out right now, and you've got all the cotton that you need. And we see, well, Claire says, well, I really need to have some chickens because I want to be able to grow eggs for my family. I'm gonna say, well, I really need a pig because I think bacon is delicious. Um, so it's like, well, Claire says, well, I don't have a pig. I said, well, I don't have any chickens. But Claire says, I know a guy who's got a pig. So, well, I think my sister probably has some chickens that she'd be willing to give up. Let's see if we can maybe figure out, okay, well, if I take some of your apples and I trade those to my sister for the chickens, then now I've got chickens. It's like, well, can you talk to the guy that you know who's got a pig? You get the pig. Now, great. You've got the pig. I've got the chickens. We find a way to swap around that. Well, that becomes extremely inefficient as far as commerce is
Mm.
concerned. And so
Mm.
we say, you know what? This whole idea, our non-parity of values means like you don't have what I want, I don't have what you want. We don't have parity on
Mm.
our relationship. We don't have
Uh,
parity in we that's there's a more precise term that's escaping
that's
me right
okay.
now, but this idea, you get the picture. So you
Yeah.
see, so we say, you know what? Let's find something that is reasonably scarce and let's just assume that we can trade quantities of this thing that's reasonably scarce and that'll be our proxy for trade with each other. But let's say we agree that there's this really pretty rock that we found that's it's rare enough, but we can find enough of it that we can say, okay, well, we can create a quantity around this. It takes some work to to get to it. It takes some work to polish it up and make it pretty and usable in this medium of exchange. And then you say, you know what? Maybe it's time for me to get some more apples, but my cotton product is, I've sold all my cotton to somebody else because they're going to give me a whole lot of these shiny, pretty rocks for my cotton. When you say, you know what, I'll take a stack of your shiny, pretty rocks in exchange for these apples. Great. We've now created a monetary good. We've said, okay, well, now we've created this medium of exchange that's not cotton, It's not apples, it's not pigs, it's not chickens. It's this thing that we have agreed as a community, we have agreed that this has value.
Value.
And so it's an act of faith. It's an act of network assent that we all agree that this
Wow.
thing has value. And so that's
Wow.
how money starts to form. And then um, governments rise, empires rise. You have the emperor, you have the king, you
Mm.
have in our world now, you have democratic republics that have treasury departments, and so they centralize the decision about what is money. And so they say, well, we will produce a certain amount of this money. And by the way, because we have a military, we will enforce the use of this good as money. Because
Whoa.
we will. This is the only we can decree that this type of money is the only money you can use in our jurisdiction. And so that's how fiat monetary systems get created. They are forms of money that are issued by and at least putatively backed by the issuer who says what they're worth and who can decide how many to produce. And
Yeah.
it creates this machine that then says, okay, well, I don't think it's a surprise to anybody listening that you're an employee of mine. And I'm an employee of our company too. It's like, well, we get paid in dollars. And so it's like, well, okay, so now Bespoke has a electronic ledger at the banks that we choose to bank with. And then every month we debit that ledger, an amount to pay you, an amount to pay me, an amount to pay every one of our team members, an amount to pay all of our vendors, and then it gets credited with the dollars that our clients pay us or that we otherwise earn in markets. And so it just becomes this electronic ledger of dollars that don't even really exist in the real world. It's like there's not like paper dollars going hither and yon. They're just moving from one ledger to another ledger
Yeah.
um, through centralized intermediaries. So the banks that we store our money, the banks that keep our ledger, get paid to keep that ledger. When the bank moves it from Bespoke's ledger to your ledger or to my ledger, the bank gets to take a piece of that. If you have a different bank, even if you have the same bank, you get another bite at that. Well, what happens if we're not doing it in dollars, but let's say that we're paying with a debit card or a credit card? Well, not only are the banks now involved in the transfer of this value between Bespoke and you, or Bespoke and me, or Bespoke and our clients, but let's say that we're paying with credit cards on this. Okay, well, now you got merchant service processors who, like this is Visa, Chase, MasterCard, um, American Express, whatever, they want a piece, usually 2 to 3% of every transaction. Every time you swipe your credit card or debit card, the merchant service processor is taking a piece of all of those
Yeah.
things, and it's in percents. It's not like in fractions of a percent. It's it's you figure it's going to be a minimum of 2% for every transaction. You went to the coffee shop, bought yourself a coffee with a credit card or a debit card. 2%, 3% going to the merchant service processor and the various banks that are involved in that. Well, that's the way centralized fiat
Yeah.
monetary systems work. Well, what Satoshi Nakamoto solved for was what would happen if we just blew that whole thing up?
Yeah.
What would happen if we could just operate truly peer to peer without centralized intermediaries and we could trust in the finality of the transaction? He solved that through math and cryptography. And so uh, he said the way what he solved for was the ability for you and me to transact directly in a monetary good. In this case, it was called Bitcoin, transact directly with each other as a monetary good without having to go through JP Morgan or Citibank or Visa or MasterCard or Schwab or Fidelity or anybody else and just go strictly peer to peer. And rather than lose 2 to 3% on every single one of those transactions, the independent distributed miners all around the world would compete with each other to then see who can prove that I made a transaction with you. And the reward that they would get for expending energy and resources to compete for those transactions is the mining reward. It's either the block reward for solving the block in the blockchain and or they all if the miner that establishes the first is the first one to create the block in the blockchain, which is the bundle of all of these transactions of Bitcoin that take place during the course of any 10-minute period of time is when it's how it works. They not only get the block reward, but they also get all the transaction fees. But we can and have sent many, many millions of dollars around the world on the Bitcoin blockchain for pennies, not percentages, pennies.
It makes sense to me why all of this stigma would be, and how all of this fear is kind of created is because it's essentially like really shifting like power and control balances that are challenging like systems that have been like pretty confident and in control. So
yeah, and
yeah.
Name a more powerful force than the global financial industrial
No,
complex.
literally. No, literally.
And governments that issue currencies. I mean,
Yeah.
it turns it all upside down.
Yeah. So
And some of the stigmas, warranted. I mean, Bitcoin went through its phase of funding things that were illicit
yeah.
on the Silk
Yeah.
Road.
Yeah.
Um, to a certain degree, there are still transactions that are settled in Bitcoin that are illicit transactions,
Yeah.
either getting around sanctions or dealing with narcotics or cybercrime and stuff like that. But the more we understand about the blockchain and how the blockchain is this transparent, immutable ledger, meaning that every transaction in the history of time is preserved forever. It's like, okay, that's a really dumb place to conduct illegal activity.
Yeah.
And the more we understand about the blockchain, the more people understand that reality because of the arrests, the seizures, the forfeitures that have come through understanding illicit transactions in the
Yeah.
blockchain.
Matt, I'd like to ask you about custody and privacy and kind of piggybacking off of what you're mentioning. I read recently, I was actually shocked to read this, that that the Bitcoin targeting, it was or was thought of as only being for people with significant amounts of wealth in Bitcoin, but actually it's affecting people with even smaller amounts, like we're not talking millions, but maybe hundreds of thousands, which surprised me. But I know that, and this is also how I think times have changed a bit since 2017, where there is more of an understanding for Bitcoin holders, kind of like about some of the risks that are coming along with the mainstream. I'm making up a word, mainstreamness, but I guess what I should say, the mainstream adoption of it all, like and being private and being safe. Like this is a real concern for Bitcoiners with a lot of Bitcoin, which are who we work with. And so is there anything can you shine some light on how we look at custody, how we look at privacy, and how we support, folks in that situation?
Yeah, I mean, I think that the first thing to realize is, I mean, privacy, it's OPSEC really, it's operational security, but it has to do with I think the first line of defense is just not being a dumbass. It's like the if you are walking in a rough neighborhood with a lot of jewelry around your neck and you are putting yourself out there, whether it's in social media or just walking around glitz and glamour all the time,
Yeah.
it's like you're making yourself a really high profile target.
Yeah.
And so the first order of business, I think, is just understanding the risk and being modest about how you live your life. You'll never see me wearing a Bitcoin t-shirt. We don't tell clients to walk around. We suggest to clients don't walk around with your, to the moon ball cap on. If you want to do that at a Bitcoin conference, I suppose, that's fine to some degree, but don't go to the baseball game with a
Yeah.
Bitcoin sticker on your water bottle or
Yeah.
a vanity plate that says crypto bro or whatever. It's like, I
Yeah.
mean, you're just being stupid at that
Yeah.
point.
Yeah.
But that sounds like it's glib, but I think that that's a way to start the conversation. And I think beyond that, the um, the idea to my mind is that you shouldn't put all of your eggs in one basket, knowing that, because basket handles have a tendency to break. And so you want to spread around your Bitcoin holdings just like you would spread around anything of tremendous value, whether it's tremendous value in real terms or just meaningful in your own personal economic terms. If you don't want it to be taken away from you at the end of a $5 wrench attack, then don't keep it all with you. Um, I think feel free to keep some, but if it's economically meaningful for you, and if it would really suck if you were to lose it, then it's worth segregating into different buckets. And then if we start getting into some tax structuring and some family legacy structuring or some charitable structuring, then that requires an even more advanced construct for where do you put your Bitcoin holdings.
Yeah, and this makes me think about the sovereignty paradox. For those listening, Matt has a white paper called "The Sovereignty Paradox: Managing a Bitcoin Legacy," where you shine light on a paradox that exists within the what would you say, the Bitcoin ethos, I guess, or kind of the origin story.
Yeah, it's just probably like it's part of it's a bit of a paradox in the Bitcoin narrative, I think.
Yeah, and so for again, I do believe, especially for those who are listening to this, like who are ready to they've gotten over the hump of holding not your keys, not your coins, could be limiting or a bit more risky than they want. And they're sitting here curious about those ownership structures that actually do give you more control and sovereignty in this kind of paradoxical way. Do you want to introduce that a bit more, and the difference between transactional sovereignty and legacy sovereignty?
Yeah, I mean, thank you. I was kind of alluding to that a second ago, but the idea behind this sovereignty paradox came from, again, my 8-year journey now in the Bitcoin space, because for so long, and and the narrative persists even today, this whole idea of not your keys, not your coins. If you don't have unilateral control over your Bitcoin, you cannot trust that you know where it is. And there's validity to that. I mean, that's, I don't want to diminish the reality that giving control over Bitcoin is a surrender of some level of sovereignty. That's that's legitimate. That's fair. My But the point in the sovereignty paradox is that when that narrative around not your keys, not your coins really took hold in the era leading up to and then the fallout from Mt. Gox, which was a famous Bitcoin exchange that was hacked and ultimately collapsed in 2014, under which I believe it was about 800,000 Bitcoins were lost forever from the people who had their Bitcoin sitting on an exchange at Mt. Gox. They didn't have self-custody of their Bitcoin. It was stored on the exchange. And so the exchange got hacked, the Bitcoin gets drained, the Bitcoin is lost. And so that's really where the not your keys, not your coins narrative starts to become very popular. And then we see that again and again and again through Three Arrows Capital, through Celsius, through BlockFi, through FTX. It's like, how many times do people have to leave their Bitcoin, or then in the broader crypto space, leave their crypto on an exchange somewhere or entrust it to some third party who either gets hacked or turns out to be a fraudster or is otherwise unreliable, and they lose their Bitcoin. And so the whole idea of not your coin, not your keys, not your coins, there's it's got a very strong gravity well. So the paradox is that this begins to break down as the value of the Bitcoin becomes more and more economically material to the owner of the Bitcoin, because the unfortunate reality that we have to hold up for people is that, this Bitcoin um, still exists in a world that is governed by fiat rules. You are still subject to tax. You are still going to die. You will still ultimately transfer the value and the Bitcoins themselves, but the value of with those Bitcoins, you're going to transfer that to somebody at some point. It's going to go to your spouse or your partner when you become incapacitated or die. It's going to go to your kids. Bitcoin is a very complicated asset. Are they prepared for the technical sophistication it requires? And even more so, are they prepared for the economic weight that comes along with inheriting a tremendous amount of wealth that they didn't build? So it's like, I get the whole not your keys, not your coins. I mean, there's legitimacy behind that maxim. The but where it starts to break down is in the grim light of our own mortality, and the fact that and just the grim reality of human frailty. Because if I transfer hundreds of thousands or millions of dollars worth of Bitcoin to my children, will they have the technical skills to manage it? And more than that, will they have the maturity and the good luck to be able to prevent themselves from getting divorced or getting sued and having the wealth that I have transferred to them, Bitcoin or dollars or real estate or anything else, will they be able to receive that in a way that helps them become the best versions of themselves? And so I think this is the I think part of the paradox is just this awkward adolescence that Bitcoin is going through right now. It's like, wait, we're all just like YOLOing crypto bros, doing the whole cypherpunk thing, give it to the man and whatever. And it's like we don't have to play by those rules. Like, oh, wait a second, yeah, we still have to play by those rules. And then we start to try to unpack the fact that these rules can actually work to your advantage, but it requires a more nuanced understanding of what sovereignty means. It's not just transactional sovereignty, be able to go and buy your cup of coffee or your round of pints or your bag of weed from whomever without any intermediary knowing. There's that transactional sovereignty, but when we apply a more sophisticated form of sovereignty to thinking about, how do I invoke all of the rules in my favor so that the wealth that I pass on has an impact in a meaningful way? I'm trying to reframe sovereignty into a more expansive definition of what sovereignty means. It's not just controlling the change in your pocket, it's controlling the totality of the circumstances that govern your wealth.
I want to pull on some threads that I found in there that that require trust. There's this, when we talk about custody and kind of where the mindset came from with Bitcoiners and really people who were not, as getting involved with Bitcoin because they wanted to get rich, but getting involved with Bitcoin because of like just the fundamental values.
Yeah, the disintermediated, the freedom side of it.
Yeah. And now, right? Like we're watching institutions that we kind of like can't trust
Mm-hmm.
infiltrating a bit, or maybe it's posturing, I don't know, or kind of coming in and absorbing this asset. And so
Mm-hmm.
then that must, I mean, I'm not I don't have like substantial Bitcoin, so I can't I can only imagine or try to put myself in the shoes of somebody who is in Bitcoin for the values, like the challenge that it is to identify who in the space, right? Like you can trust, what companies, organizations that are building around Bitcoin can you trust? And this is Matt, this is a big question, and I don't expect you to have an answer for it, but maybe a way in, um, a way into that is I'd love to hear how you, as you've been building Bespoke and as you've been growing with the Bitcoin space and in this world, like how do you vet partners and assess, trust?
Yeah. Well, I think first of all, I think I don't mean this glibly. I think that you don't trust anybody in this system. I think I think that by which I mean it has to be transparent. That's the beauty of the blockchain is you can see the address on the blockchain where Bitcoin sits. And so I think you have to require transparency to the address level to see that the Bitcoin that you believe is there is actually sitting there. It's like don't trust, verify. Um, the your dollars aren't sitting at the bank. Your dollars are rehypothecated out across the global financial system. And the reason I know this, I mean, I know this firsthand. Um, when I wanted to buy a car a few years ago, this is a constant theme because I know we've talked about me buying other cars in the past. This is a different car. Because I have bought a car
Okay.
with Bitcoin on chain. This is a car I wanted to buy with dollars, and the seller insisted on dollars. Wouldn't take an ACH, wouldn't take a cashier's check. He wanted dollars. And so I had to go to a bank and get a little bit more than $40,000 in cash to go buy this vehicle from this guy. It's like, really, you need cash? And so that exercise in, I mean, I had the money sitting in my account, but when I went to the bank and said, I want to withdraw $43,000 worth of cash, they said, I don't think we have $43,000 worth of cash. It's like, you got to be kidding me. I know I've got the money and you're a pretty good size branch. It's like, I need $43,000. Well, the first question is, why do you need $43,000? And
Wow.
as a Bitcoiner, I my immediate response was, it's none of your damn business why I need $43,000. It's my money. Is it not my money? It's in an account that's got my name on it. Why do I have to get your permission or tell you why I want to get this cash? But being an obedient guy in some cases, I told them I'm buying a car. I said, well, let me ask the manager. So they go back and ask the manager and say, oh, you're in luck. We got a delivery of cash today. And so I waited while they counted out $43,000 in $100 bills, double checked it, and then I had to walk out of that bank with $43,000 in envelopes in a backpack, feeling as conspicuous as you could possibly
Yeah, I
feel.
was like, that's a very
Um,
cinematic moment.
it is. It was, yes, it was stressful for sure.
Was it?
It was. Um, and So I made that trek and that transaction, and I bought the car, and I still have that car, and it's I love it. But
If those have been spending enough time with us here, you'll know that Matt loves cars.
yeah, but it's like that that was a lesson for me that you cannot trust
Mm,
the intermediaries who
mm.
are entrusted or who are even paid to custody your assets. It's like I could see on my ledger in my bank account that I had the money, but I didn't have visibility to where the money is stored to be able to actually pull that money out. Bitcoin is very different. When you see the ledger in the form of your wallet ID address, that address shows you the quantity of Bitcoin that's held at that address.
Okay, so now I want to ask about digital asset cryptocurrency or Bitcoin custodians, because there is a process that I'm making the assumption that you have vetted our custodians, and you did a thorough vetting, you did your due diligence, and then you came to the decision. This is the right choice. Um, how, why?
It has to do with choosing what's the right way to frame this? The least bad option, perhaps, or and I don't mean it, I don't mean to sound, I don't mean that to sound as negative as it sounds, because I think there really is no purer form of Bitcoin ownership than unilateral control. But again, as I mentioned, that breaks down as the value grows and as we get old and die and
Yeah.
whatever. It's like,
And when you're when you're I don't know if a realist is the right term, but when you recognize the circumstances in which
yeah,
where we are currently, and
it's when
kind
you're
of like
pragmatic. Yeah, it's like
there are some sacrifices that I guess have to
it's
be.
just trade-offs.
Yeah,
You
right,
have to
right.
make trade-offs. And so it's like, but yeah, how we go about vetting qualified custodians really goes to the security profile of their key management system and their regulatory posture, the regulatory profile of these entities. There is a growing number of what are considered to be qualified custodians. That's a definition under the Investment Advisors Act. It's a defined term. Um, but even beyond what satisfies the defined term, there are grades of sophistication when it comes to these qualified custodians, and there are levels of regulatory oversight. We seek to use the qualified custodians that meet the very highest standards. In the United States, for example, there are some qualified custodians that have a federal banking charter as opposed to just a state banking charter. So there's a number of state regulated qualified custodians that meet the statutory definition, and they are backstopped by the banking commissioner of the state that regulates them. New York has some qualified custodians that are backstopped by the New York Division of Banking. There are some in South Dakota that are backstopped by the South Dakota Banking Commissioner. Then there are some that are federally regulated digital asset banks that are backed not by any particular state, but by the federal office of the comptroller of the currency. So rather than rely on the New York State Banking Commissioner or the South Dakota State Banking Commissioner to ensure that the assets are properly managed and available in the event that custodian were to become insolvent for some reason, we prefer to rely on a custodian who has the backstop of the United States government as opposed to any particular state. And so that's one of the criteria that we measure qualified custodians against. And so whether they're based in the United States or based abroad, we look for the qualified custodians who have the highest level of regulatory oversight so that they are less likely to fail. And if they were to fail, they've got the biggest backstop that exists. But the we don't really believe that people should put Bitcoin necessarily in qualified custody if there's not some other reason to put it there. And by which, again, we get back into the tax structuring, we get into the family structuring, we get into the planning for this eventual death or decline or whatever. And so that this is part of the sovereignty paradox. This notion that you should have sovereign unilateral control over the amount of Bitcoin that you are willing to die with. And then the stuff that you would rather not die with, do something more structured with it. And then that means at least multi-sig. And if you want legal predictability, you probably need more than multi-sig. You probably need a trust of some sort or an entity inside of a trust that then has qualified custody to know that when you die, not only is the Bitcoin there, you can see it sitting on chain, you also have the reliability of generations, in fact, centuries of legal precedent that tells you how trusts and fiduciary relationships work. Stack those things up in your favor, and then you have a higher probability of successfully transferring that Bitcoin to the people that you care about in a meaningful way.
Matt, this reminds me earlier we were talking about alpha. Is there anything else that you think might be useful to cover when it comes to how we address all of the unique investment challenges that Bitcoin presents? I know we touched on it earlier, but I wonder if there was anything else there to round that out.
Yeah, I mean, Bitcoin is notoriously not income producing. I mean, in
Right.
some cases, I mean, aside from its market volatility and what it does on a day-to-day basis, just the beta of the asset, there's no additional accretive income that Bitcoin spins off. Nobody's going to rent Bitcoin. It doesn't yield an income stream. Um, and so there is a temptation, understandably, for people to seek additional sources of income to extract additional value from their Bitcoin. And I think the time will come when there are proven and reliable and trustworthy ways to get there. But Bitcoin is inherently a very patient type of asset. And the beta on Bitcoin has been so good over the course of, I mean, not just 17 years, just over the course of the last 5 or 6 years. Bitcoin's beta has been amazing. And so, why you wanted to squeeze something and the income, the alpha is only going to come with the assumption of some risk. It's like you're going to have to then put your Bitcoin into something that is generating risk because the alpha is hopefully reflective of the additional risk that you're taking on with the asset. It's like there's some you have to put that Bitcoin into commerce in some way through a lending facility or something in order to be able to get additional income off of that. What's very, very common is that people with Bitcoin will place that Bitcoin with a lender. This is what Celsius did. This is what BlockFi did. This is what other companies have done and failed and still do and still succeed. They then aggregate Bitcoins and then they lend those Bitcoins to miners who are mining Bitcoin. And then the miners will use those Bitcoins, sell those Bitcoins at market, um, and then repay. But the lenders who are sitting here in the middle, the intermediary who is sitting here in the middle of this
Right.
transaction,
Yeah.
they're getting paid maybe 10, 12, 14% on their loan. They're paying you 8%, 6%. But then if you got another intermediary like an aggregator fund, they're taking their 2 or 3%, and they're going to give you 1 to 2% of all of that. It's like that's again, we are introducing intermediaries into a disintermediated peer-to-peer electronic cash system. And so
Yeah.
all these intermediaries present risk vectors
Right.
because they now have to have custody.
Yeah.
How solvent are they? When the miner goes bankrupt and fails to pay back the loan, who's going to pay the depositor back? It's like it's still just it's too new, I think, for us to be able to trust it at scale.
Right.
And but these are lessons that I personally learned on a much smaller scale as a as participating in BlockFi and Celsius before those things blew up. It's like, but you cannot, you put your hand on the stove, a couple of times, maybe you start to learn that
Yeah.
the system's not ready yet.
Totally. Yeah.
And so I think the time will come. My perspective and Bespoke's broader perspective is that Bitcoin is too precious of an asset to put at risk in these types of ventures.
I want to zoom out kind of for the maybe the remainder of this conversation. I want to zoom out. And again, when I said at the beginning of the episode, I'm coming back to that. Is Bespoke's relationship with Bitcoin and clarity on that. And so, yes, it is true that we've built around Bitcoiners, but we are not. Bespoke is not only suited to manage and be a multifamily office for Bitcoin wealth. We are positioned for regardless of how you built your wealth. And I think it's interesting because I think that there are some like values that have kind of rolled. It's kind of like it's like rolled off the back of like the Bitcoin, like that was our foundation, and then but they apply to other kind of our approach with other assets. So, I think this conversation I know is going to be super helpful for, any lawyers or CPAs who are trying to understand kind of this asset, who might be having clients who are, coming to them with questions. I think that this conversation really clarifies our perspective for the Bitcoiner who has um a ton of Bitcoin. But I want to add something in this conversation for um I think the wealth builder who built their wealth not in Bitcoin.
Yeah, I think that's great. I would say that Bitcoin was um the bridge that got us to where we are, but that's not what started this journey. Regardless of the source of wealth, whether it's Bitcoin or whether it is a successful company or whether it is inherited wealth, whatever it is, I think what makes us very different is the origin story from a law practice that was built around generational wealth preservation. That lens through which we look at the totality of a family's wealth. Bitcoin just happened to be the impetus that brought us to where we are, because we saw a massive need that was unmet for some people that we liked and that we felt deserved better than what was available. And so I don't think Bitcoin I mean, again, I don't want to diminish the importance of Bitcoin as a superior form of money and as a superior asset. And I am dedicated fervently to Bitcoin and Bitcoin's success. And at the same time, um, the way we view Bitcoin is the way we view everything. It is it's an asset. It's a form of wealth that usually means something to the owner of it. And we spent the better part of 3 decades where our focus was on helping families with significant wealth protect that wealth, maintain privacy around that wealth, achieve some level of reasonable tax efficiency around that wealth, and create a form of scaffolding that will support their family as their family grows through time. That's what estate planning is, in our view. I mean, estate planning takes the form of various trusts and other LLCs and partnerships and other entities, all that kind of lawyer stuff. But there's a mental framework that you apply to create scaffolding to protect family wealth as it grows, and to make sure that as that wealth continues to grow, both in economic terms and in human capital terms, as generations rise, um, that the scaffolding is there to protect it. And that's the wealth strategy side of our business. And that's what defines how we look at wealth, whatever it's based on, whether it's, again, inheritance, Bitcoin, private companies, crypto, doesn't matter. We happen to have specific expertise and a passion around Bitcoin because Bitcoin, like I said, is what brought us to where we are. But a lot of what makes us very different is that we didn't start out as an investment company. We didn't start out as a wealth management company. We didn't start out as a bunch of wealthy dudes who pooled our money together and started doing all this kind of cool venture stuff. And that started to take off. And we started selling subscriptions to other people and say, hey, come co-invest with us. We got great deal flow and all that kind of bull crap that so many other family offices, air quote, claim to be around. It's like, no, that we don't do any of that shit. It's like we build family legacies. And that is what our core is. That's why we built what we built. We happen to build it in the shadow of Bitcoin for this first family. And because of, I suspect, because of my outspoken passion for Bitcoin and the fact that I'm kind of hard to shut up sometimes, it created this flywheel. And so the more I talked about Bitcoin, the more I talked about legacy, the more there's nobody in the Bitcoin space talking about what we're talking about. And so that just created the momentum that built Bespoke to where it is. And along the way, those families that wanted to take their wealth seriously and wanted to build scaffolding around the family wealth, they say, you know what? This Bitcoin has been really great to us, but there's some things we can't do with Bitcoin. We can't necessarily send our kids to college with Bitcoin. We can't necessarily invest in other companies with Bitcoin. Bitcoin doesn't necessarily directly fuel my philanthropy. And so, how can we take this Bitcoin that's a significant part of our family wealth and start to peel that off in intelligent ways, and then either reinvest in things that we also believe in that just aren't Bitcoin, or um, that are part of the foundation of building the world that we want to see. Maybe it's a cleaner world, maybe it is a world of greater equity, whatever that is. And how do we use the wealth that we built in Bitcoin to then do those other things? And it was around that need that we built the investment company within Bespoke, and that's what fuels the philanthropy work that we do with our clients. But it's the fact that um, we didn't start out we didn't start this journey saying, hey, we're going to become this multi-billion-dollar wealth management company. No, it's like we're just a bunch of people who are kind of gathered around this singular purpose of serving clients who need service and helping them as comprehensively as we can, as creatively as possible, as authentically as possible, and help them become the truest versions of themselves, build the scaffolding that as their wealth grows, it helps the rising generation become the fullest version of who they are. Um, that's what we built around.
Matt, thank you. It was a pleasure to talk about all of this today. As always, I'm left looking forward to the next conversation. But thank you.
Absolutely.